Hello, everyone. This is the voice of Richard. You're welcome to Forex Empire tutorials. Today, we are actually going to be talking about other types in Forex trading, right? Other types in Forex trading. And we're going to go into it, and you need to know that other types simply refers to how you enter the market or exit the market, all right? How you enter the market or how you exit the market. Here we'll discuss different types of orders that are being placed in the Forex market. So other types are, you know, uh, they are actually categorized into two. All right. So we have the market order and we have the pending order. So the market order is an order which is instantly executed against a price that your broker has provided, while the pending order is an order that you place at a particular point and you expect the market to get to that place later on to be activated. You get? So the different types of uh, this thing orders are the two categories of other types in Forex are the market order and the pending order. Market order, for example, you have your Euro USD and your broker has actually given you a price at 1.2140, all right? And the ask price at 1.2142. So if you wanted to buy Euro USD at the market, that is instant, then you are actually going for the ask price, which is what? The 1.2142. And if you click buy, your trading platform will instantly execute that buy order. All right. So it's more like a one-click trading stuff. You just go into the market and you just buy. You don't wait for the price to go to a particular point or a particular place or a particular time for it to be activated. This market order is just instant. So the only difference is that you are buying one currency and selling one currency against other. So you are not going to the market to buy and sell, like you are not ordering any food online or whatever. All right. So this is market order, and in market order it is instant. All right. So you need to also keep in mind that depending on the market conditions, there might be difference in server time between when your market is executed and when it is executed in your trading platform. All right. You might execute the market order now before your broker will activate it. The price might change. The price might change. So you need to keep in mind of that. So in that market order and pending order, we have the limit order. Limit order is a type of pending order. Pending, waiting. A limit order is an order that is placed either buy below the market or sell above the market, okay, at a certain price. So this is an order to buy or sell once the market reaches a limit price. So there is a particular limit the market will go to. There is a particular limit the market will sell to, and you place a buy. There's a particular limit the market will get to, and it will trigger your sell. You understand? So you place a buy limit order to buy at or below a specified price. Then your sell limit is an order to sell at a specified price or even better. So once the market reaches that limit price, the order is triggered and the limit is executed. If you look at this diagram here, you see different sell limit and buy limit orders. That is how it is. So here, orders placed below price and price then goes up. This, the current price is the blue dots, all right? The current price is the blue dot, and you are anticipating the market to get to this green line for it to buy. So you say the image by the side is the blue dot, which is the current price. So you notice how the green line is below the current price. If you place a buy limit order, the order will be triggered and the price would have to fall down to that point. You understand? First, before it activates. Likewise, the sell. So notice how the red line is above the current price. So the blue dot is the current price, and you wait for market to get to this point and start selling. That is a limit order for you. So for example, if Euro USD is currently trading at 1.2050 and you want to short the market at 1.2070, you can either wait for the price to hit 1.2070 or you set a sell limit order at 1.2070 and you walk away out of your computer. All right. So if price goes up to that 1.2070 in your trading platform, it will automatically execute and take you into the market. So you use this type of entry when you believe that price will, reverse when it gets to a particular point. So a limit order to buy at a price below the current market price is executed at price equal to or less than the specified price. All right. A limit order to sell at price above is just the same thing. It's vice versa. You have the buy limit and you have the sell limit, just like we illustrated earlier. So the stop order is also a pending kind of order. The stop order stops an order from executing until price reaches a stop price. So you will use a stop order when you want to buy only after price rises to the stop price, or sell only after price stops to the stop price. So a stop entry order is an order that you buy above the market or you sell below the market. So you place a buy stop order to buy at price above the market price. For example, you have the market going up, right? Going up, and you anticipate that this market is actually going to go up again from this zone, right? You can put your buy stop order here. You can put your buy stop order here too. You can put your buy stop order here too. So the market will go above it. Remember, price have already been going up. So you are buying above the market price. That is a stop order. While a sell order, you have the market going down and you believe that this market is going to go down below this point. All right. The market is already selling. You place your stop and the market sells below it. That's an example of buy stop or sell stop. So the buy stop, you buy at price. You buy when the price is above when you buy at a price above the market price, then sell stop, you sell at a price below the market price. So in this now, you see the buy stop, you see the current market, the current price is the blue dot. So you believe that the market is going to go above this price. You put your buy stop and the market will trigger it and pass through. The same thing with sell stop. The market will trigger it and pass through. All right. So for example, GBP USD is currently trading at 50.50, 1.5050, and it's heading upward. You believe that price will continue in this direction if it hits 1.5060. You can do one of the following to play this belief. Sit in front of your computer and buy at market when it hits 5060, or you set a stop entry order at 5060, and once the market gets to that place, it goes through it. In order to close out of the market if the market price reaches a specified price, which may, this is stop loss order. This is stop loss order. The stop loss order is your account's safety net. All right. So it's an order to close out of that position if the market reaches a specified price, which may represent a loss. All right. So a stop loss order is a type of order linked to a trade for the purpose of preventing additional losses. All right. It prevents you from additional losses. It prevents you from additional losses. So if you are in a long position, it is a sell stop order. If you are in a short position, it is a buy stop order. So a stop loss order remains in effect until the position is liquidated or you cancel the stop loss. So if you went long on Euro USD at 122.30, to limit your maximum loss, you set a stop loss order at 1.200. So it means that if the market drops below 1.2200, instead of moving up, your platform will automatically execute a sell order at 1.200 in the best available price and close out your position for a 30 pip loss. So the market will actually take you out on a loss instead of you incurring more, more losses. What do I mean? You have your trade here and you want this market to actually move up. All right. So let's say you were wrong and this market didn't move up and this market starts going down. You have your stop loss order here. Your stop loss order prevents this market. Oh, let me use the red column. Let me use the red column. So the market is going down and you are anticipating that this market is going to buy from this zone. So you put your stop loss order here, right? While activating this, the market will just go to this point and move up. Now, if this market did not move up, the market starts selling. This market will take you off of this market at maybe how many pips loss? In Euro USD, it was 220, while the stop loss order was 2200, so 30 pips different. So this market taking you out of this in loss, you are going to lose 30 pips in total because you have a safety net of your stop loss order taking you out of this market in 30 pips loss, instead of incurring 40 pips loss, 50 pips loss, and others. So that is a typical example of the stop loss order. So stop losses are extremely useful if you don't want to sit in front of your monitor all day, worried about whether you lose your money and all that. So you just set it on any of your open positions, so you don't miss your, activities, any other activities that you want to run and all that. So stop loss order, which is attached to an open position, automatically moves once in profit and becomes equal or higher to a level you specify. There is also what we call a trailing stop. And this trailing stop is a type of stop loss order that is attached to a trade that moves as price fluctuates. So if you are in 20 pips profit, the stop loss, the trailing stop moves in 20 pips. So you can actually set your trailing stop to move at any 20 pips interval. So let's say you decided to short USD JPY at 90.80 with a trailing stop of 20 pips. So if your stop loss is at 91.0 and the price goes down to 90.60, your trailing stop will move down to 90.80 or break even. So if you move 20 pips in profit, the trailing stop will move into profit and secure your entry point. That is what the trailing stop is. So you just remember that your stop loss will stay in this new price level until the market moves further. If the market does not move further, the trailing stop will stay there. If it goes in loss of 20 pips, let's say you're already in profit of 20 pips and the market moves 20 pips further, the trailing stop will close 20 pips. That is, once you have the USD JPY at 90.40, your stop would move to 90.60. Then your trade will remain open as long as the price does not move against you by 20 pips. Once the market hits your trailing stop price, you will be out of the market. That position will be closed. So limit orders versus stop orders. Most of the time, we confuse limit orders and stop orders. Limit orders is you are actually waiting for the market to get to a point before it activates. All right. Both type of orders allows you to tell your broker, okay, I want you to activate this market at a particular trade point. All right. But the difference is the purpose of the specified price. So a stop order activates when the market reaches or passes. When the market passes a specified stop price. Okay, that is what the stop order is. Then a limit order is when the market reaches a specific point, then it will activate. Just like your Euro USD, you are trading at 1.1000 and you have a limit entry order to buy at 1.1009. Your order will not be filled unless you get filled at 1.008. You understand? So that is just it. So think of a limit price as price guarantee. By setting this, you are guaranteed that your order only gets executed at your limit price. So once the market reach your limit price, your order will execute. But if it did not get to that place, your order will not execute. So in the previous example, Euro USD may fall down to 1.1009 before skyrocketing. So even though you wanted to go long, your order was never executed since you were trying to enter a long position at a cheaper price. So your Euro USD will move without you. So this is the trade-off when using a limit order instead of a market order. Remember, market order is instantly. Then limit order, it just comes, pick up your order and moves. It comes, pick up your order and move. So that is that for our sections. We have an ebook that would further explain the terminologies. I'll also give you an assignment in the ebook and all that. Once you download this video, the ebook will also come with it, and you would read the ebook and do every necessary thing. Until that, I wish you good luck and happy trading.